So today I have with me Jennifer Richardson from 123 Financial Group up in or near Newcastle, but you're actually, where are you located?
So we're at Charlestown, Andrew.
Charlestown, excellent. And the reason why I've got you on today is I wanted to ask you a few questions as someone who is an accountant. I understand you're also a financial planner, but you also run a brokerage as well. So you have a really good understanding of our industry, what it takes to be a great broker. But what I really need to talk to you about is something which I've come across recently that has kind of shocked me a little bit, is the number of brokers in our industry who, when they first get into the industry, they start their business, open an entity, a lot of them as a sole trader. And then as their business has continued to grow and mature, they actually haven't gone back and reviewed their business structure and how that entity has been set up. And there's some pros and cons of that, which I think I'd like to have a bit of a chat with you about today. The other thing which I just want to acknowledge is there is a lot of talk out there right now where the regulators, or the tax office is actually looking at the mortgage broking industry and aggregators who have sole traders under agreements with them, and asking the question whether the aggregators should be paying payroll tax. That's a topic on its own. However, what that is going to do is definitely generate conversation in our industry around, how should mortgage brokers actually set up their corporate entity or their business. So my first question for you today is, when you are starting out in business, is being a sole trader a good first step?
Being a sole trader is the simplest form and the least complicated form. There's pros and cons to everything, of course. And if the biggest pro is that it is a cheap form. You don't have all the added accounting costs and things like that. It's also easier to manage. So it's pretty much income in, expenses out. Whatever you're left with is your profit to spend how you like, as long as you've paid your tax on it. The biggest con of it, of course, is around asset protection. Because, of course, if you're trading in your own name, then anything that can go wrong, your own personal assets are on the line. It also doesn't have as much separation, I find, between the business accounts and the personal accounts. And so we quite often find people that are working as a sole trader, they have one account, the business money comes into it, personal expenses are coming out of it, business expenses are coming out of it. And before long, they've got into a real cash flow issue because there's money sitting in a bank account that they then spend. And of course, then when the tax bill comes around, they haven't set aside for tax. So look, it's a good training ground, a sole trader. It's certainly not something that, as you grow in a business is probably ideal. And a lot of people have a concept as well, that there's better deductions for an individual as a sole trader and things like that. And that's not always the case. My rule of thumb, though, for sole traders is it never is suitable wherever you have assets, wherever you could potentially be sued, or if you have any employees for you.
That's really good information. So probably just some key things that you just pointed out. I think that if you've got employees, you definitely should be considering having a more mature business structure, or a business structure that perhaps allows you to facilitate proper business transactions. Definitely, your point around having a distinction between money that's for business, money that's for personal life. I've seen many brokers in their early years accidentally spend their tax. That does happen. I've seen that happen way too often. It's like, good, cash flow is coming in, I can spend it, which isn't the case. Look, one of the other points you made, which I think is vitally important, though, is the asset protection, and also protection personally. So, for example, if you have a premises that you own with the business that you're operating out of, as your trail book grows as well, as in that's definitely an asset, or any other business ventures that you have. Having that personal protection where if something does go wrong and you are sued and your PI insurance may not actually cover it, that your personal assets and your family is protected. My next question though is, when do you know, as a small business owner and you're a sole trader, when do you go, actually, okay, this is the time when I need to actually go back to my accountant and review what my structure looks like? And what type of questions should you actually be asking your accountant?
So as far as when you know, that's a really difficult one, because you'll find most businesses never really look at their how they've grown, because you're so busy on the day-to-day stuff that you just don't look back to go, you know what, my fees have tripled, my complex situations tripled, because of course, as you're in business, you're just working along and you don't realize how much you've grown as a business owner, as well as the business itself has grown. So I always say to all of my clients, every year when you sit down to sign off your tax returns is the perfect time to have the discussion with your accountant. Don't leave it to your accountant, because they sometimes, not all accountants, but sometimes they will think, oh, they'll ask me when they're ready to change incorporated entities or whether they move to a trust. But it's one of those things that you don't know what you don't know. So have a list of questions every year for your accountant. One of them is, am I in the right trading entity, or should I be changing? And there's lots of other questions, of course, that we should have for our accountant every year. But I'm very much a believer, Andrew, that you don't touch base with your accountant once a year, because, 12 months down the track, when you see your accountant, your year end could potentially have been 12 months nearly earlier, which means we're looking at transactions that are now 2 years old. And if you're not looking at things how they happen and when they're happening, you can get down a very big hole as far as debt and cash flow goes before you realize. And it's a bit like, I always say that, you're driving a car, that would be very similar to not knowing whether you've got any petrol. So covering up your whole dashboard and going, am I over the speed limit? Is the engine showing that it's hot? And, how much have I got left in the fuel tank? So our businesses, we should be looking at all the time. So the questions you should always be asking your accountant is my family assets protected in the trading entity that I am? What's my risks that I have in trading in the entity that I'm in? Is my cash flow working right? What's my forward steps? And part of that process as business owners is you should be doing a business plan. I mean, I always say people go on holidays and they spend longer planning a holiday that they're going to have to work out where they want to go, what train tickets, what plane tickets, all those things, than they do with their own business that gives them the cash flow and the income to have that holiday. So knowledge is power. Sit with your accountant. You should always, at least every 6 months, have a check-in with your accountant, because I would hate that, you sit with the accountant 1 year and then you go through this massive growth spurt and you haven't had a catch up with your accountant to see whether you're setting the right monies aside. Are you in the right entity? Is there a more tax effective way that you can run your business? But as far as the question you had around the property, if you've got a property or anything that could potentially go wrong, you should always have those assets isolated from your family assets. Because if something happens, and people will say, I've got insurance, but as you alluded to, what if that insurance wasn't enough to cover whatever you're being sued by? They're coming after your family assets if they can. So if you're in an incorporated entity, or if you're in a trust fund that has a corporate trustee, if you are sued, they will look to those entities and they can only take those entities' assets and that they can sell to recover funds, unless you've done something illegal, of course. Nothing protects you if you've done something illegal. And so your book, of course, as mortgage brokers, is a massive asset that you're trying to build. So you don't want to ever have that risking your own family home. I mean, we can all recover. If we lose our business, we can recover and we can go and get a job or we can start again. But you cannot recover if your family home and your assets are sold from under you.
Yeah, I think it's very important to reflect on that and consider and have that conversation with your accountant. There's probably another piece of that, which, we had a slight conversation earlier where, yes, as business owner, your business changes throughout the year. And you need to, I guess, touch base with your accountant to make sure that any of those changes within your business actually doesn't change your needs, from a taxation point of view or a business structure point of view. But one of the other things is that regulation changes as well, and tax law changes and that sort of thing. One of the things I hear a lot about is people having family trusts, and without getting into detail, you did mention that some of these areas are constantly changing, and as when you are considering what structure you have, it is best to contact your accountant for an up-to-date, I guess, view of the world and what's actually going on.
Yeah, that's right. I mean, the tax office is always looking at ways to increase their revenue. Let's just get that out in the open. We'd like to think that they're there to do everything else, but they're a business and they're there to collect revenue on behalf of the government. So they're always looking at ways that us accountants are finding ways to minimize tax, and they're trying to stop us. That's our job, is to minimize tax that people and entities are paying. And the problem that you're alluding to, Andrew, that we had a quick chat about was family trusts. The tax office brought out a ruling or an indication of how they were going to assess trusts, which was supposed to commence on the 1st of July. And look, family trusts have been a great vehicle for us accountants, which allowed us to use low income people so that, you didn't pay as much tax as you do in the higher income earners. But the tax office is now looking at ways that they can stop trust distributing to low income earners, which means the tax office collect less money than they would have if it had stayed in the high income earners. They released a couple of days ago their final ruling. And so, you hear this quite often in our practice. Oh, my friend's got a family trust. They said that's what we need to do because we used to. Unfortunately, when rules change, the people that are on the other end don't know that they're changing. And so it's really important that you get advice from the right sources. It's great to hear the barbecue talk and take that back to your accountant before you've decided that's the way to go. Because as I said, we hear it all the time, but my friend's got a trust fund and they reckon it's great, and it still could be great, but find out the circumstances that are current, but also that it does suit your needs. Like if you're a mum and dad and you've got 3 little kids, a trust fund's probably not going to be of much benefit because the kids are under 18. So there's all those little intricacies that are unique to you and your position. And it's important that you talk to your accountant. And if your accountant's not quite sure, find another one. And it's a bit like you go to a GP. If you didn't get something that you're comfortable with, get a second opinion. It doesn't hurt.
So accountants, like mortgage brokers, not all of them are equal.
You said that, not me.
Really, some really good advice there. The only thing I'll add to that, just in relation to, I guess, the way that government can, it's not just change laws, but reinterpret laws too, and the way they look at things. It was a few years back, 7-Eleven were hiring contractors as contractors, but treating them like employees. And off the back of that, and I think this is almost what started some of the investigations we're seeing now, is that they realized that obviously those businesses were just trying to avoid tax and costs, etc. But even as a mortgage broking business, one of the things that you need to look out for, if you do have staff and if they are contractors, contractors have to be allowed to work for more than one entity or have a relationship externally. So that's the first thing that you need to consider when you bring on a contractor. They have to be, you can't make them exclusive. The second thing is you can't make them follow a set sales process or dictate to them exactly how they operate. You also can't make them open and close your shop front at a particular time or enforce set hours on them. And the final one is that you can't, they have to provide their own tools of the trade. So that's just some of the criteria that when the Vulnerable Workers Act came out, they're looking at, well, how do we work out whether someone is a true contractor or an employee. Because the reality is, if you have a contractor that you treat like an employee, and this is my fear of what's coming once our industry really starts getting looked at, you may be up for superannuation, sick leave, payroll tax, et cetera, as well. So I think, yes, it's happening at an aggregation level, but also think within our own businesses, we need to actually look at, well, what's the structure between our staff and ourselves as well? What's in place there? Look, I think I don't want to keep you any longer, Jen. I really appreciate the time that you've given us. I think the main message that I've got out of this is you need to be talking to your accountant. And if you don't mind me, look, I know that you're extremely busy and you do a lot, but are you open that if anyone did have any questions or was looking for a new accountant, that they could reach out to you at all, or reach out to your team?
Of course. And I'm happy to jump on, as I said to you, we'll jump on and organise a quick Zoom call with anybody that wants to do it, just to go through anything. And I think just on the point that you were talking about there is it's classed as a deemed employee. Right, and that's what the tax office is looking at, because ultimately the government would like everybody to have superannuation and workers' comp so that they don't fall back into the public system. And I have a really good little saying that I say to all my clients: if it walks like a duck and quacks like a duck, it is a duck. So it doesn't matter what you call them. And if you can call them an independent contractor, but from the outside world, if somebody looking in thinks that they're an employee, then they probably are. And there, you can still keep them as a contractor, but you must pay all those other things on top. So they can still be a contractor, but you've got to pay workers' comp for them and you've got to pay super for them. And, you know, it is unfortunately one of those things that the government is trying to catch as many people as they can, because they want to make sure that they're not, you know, getting injured and then going back into the social security system.
Look, again, thank you so much. I've learned a few things by having a chat to you today, which is great. It just goes to show that it doesn't matter what you think you know or what Uncle Fred at the barbecue says. You probably should talk to a professional. So thank you so much for your time. Really appreciate it.
You're welcome. Thanks for having me, Andrew.
Thank you.